Why does inflation happen? Who influences the level of inflation in the economy? In a previous video, we talked about the fact that we need to use this modern type of money, banknotes issued by a central bank, because we need to control the level of inflation and deflation in the economy. But how do we do that? Hey, it's Dario and this is Divity Finance, a platform where we can share our best tips and tools when it comes to trading, investing or finance in general. And if you love the subject, please consider subscribing. To understand what are the causes of inflation, we first need to understand what inflation is and what we mean by inflation. And by the term inflation, we mean the raise in prices of products. So if you see in an economy that the price of bread, the price of meat, the price of milk, for example, has increased, that means that in that economy we can say that the level of inflation has increased. But there are many things that can drive the raise of prices in the economy. But in this video we are just going to concentrate on the one thing that drives it the most important thing, which is money supply. But first, if you enjoyed the video, please leave it a like and let me know in the comments down below what is the thing that you understand the less when it comes to economy. So how can money supply influence the prices and raise the prices of goods? Well, first of all, let's understand that money supply is controlled by the central bank. Every central bank can control the money supply of its currency, of its country's currency. So for example, the Federal Reserve will control the quantity of money in the US economy, so the quantity of the US dollar. How do they do that? It's not like they can print money and throw it on the street and that's injecting money in the economy. It doesn't work that way. You have to have a reason in order to inject money in the economy. You need to purchase something or you need to give to someone money, but with a purpose. So to understand this, I want to eliminate from the equation the commercial banks. Not just because then it would get too complicated. Let's just say that the central bank speaks directly to the people. It doesn't work that way. There is in the middle the commercial banks, but we are just going to concentrate on this simplified example. So the central bank will give money to people. How? Through loans. So if the central bank, for example, decides to lower the interest rates of the loans, more people are going to ask for money because money it's cheaper. So they are more interested in asking for loans because again, it's cheaper. So that way the central bank will give the money to the people and the people will spend that money. They will increase the demand of products and the products will increase in prices because of the law of the supply and demand. So if more people can afford bread, milk and meat, the prices of bread, milk and meat will increase. And how can they afford more meat and bread and milk? Because they have more money. And why they have more money? Because the central bank wanted them to have more money and the central bank lowered the interest rates to give them a reason to take a loan. Of course, people don't take loans to buy bread, meat and milk. They normally take loans because they want to invest in something. On the other hand, if a central bank wants to decrease the level of inflation, they will increase the interest rates so that fewer people want to ask for loans and fewer people will be able to inject money in the economy. So fewer people will be able to afford bread, milk and meat. But again, people don't ask loans for bread, milk and meat. They ask it for investments. But why do we need inflation? Well, to explain you this, I want to reconnect to the previous thing that I said, investments. People don't ask money for bread, milk and meat, they ask it for investments, right? So let's say for example you want to buy a house. You want to buy a house and you need $1 million, for example. Here in Switzerland, the houses cost more or less that. Okay, more or less $1 million. It's very hard to build a house with less than $1 million here. So let's say you need $1 million. Who has $1 million in their bank account in cash? Nobody. And if they do, they better off put it in another investment. Now, let's take this person who wants to build their house, but they don't have $1 million. What do? They go to the bank and they ask for a mortgage. And the bank says, no, you can't, because we cannot increase the level of inflation. So we cannot give you loans, because otherwise we would increase the level of inflation. So what happens now? The person who wanted to build a house can't build a house anymore. So the engineer who would have worked to build that house is not going to work anymore. the architect is not going to work anymore, the carpenter is not going to work anymore, the builder is not going to work anymore. And you see that without inflation, we really slow the economy, we decrease the quantity of jobs, and we decrease the quantity of cash flow in the economy. So actually we need inflation because we need to have a strong economy and an economy that works. Which doesn't mean that we couldn't make it work without inflation, because if you come out with another idea, please share it with us. But in this modern era, in these days, we have this modern economy, and in this modern economy we need inflation. Because again, we need people to invest, we need people to buy houses, we need people to make houses, and we need to make jobs. Because with inflation, we increase the jobs, we lower the unemployment, and we increase the richness of people. And so that it's also why the central banks have a certain goal of inflation, and that goal is a 2% inflation per year on average. But let's think about that for a second, because if we have a constant increase in inflation, that means that we have a constant increase in prices, which means that with the money that we had yesterday, we can buy fewer products because they cost more. So let's process that a little bit, and we come to the conclusion that we cannot put our money in our bank account to sit there forever. Otherwise, we would just lose the value of our money, the power of our money, the buying power of our money. Do you remember what I said a couple of seconds ago? I said that if you had $1 million in your bank account, you would be better off put it in another investment. And that is so true, because if you put your money in your bank account, and especially in a bank account that doesn't give you interest, such as in Switzerland, we don't have interest in our bank account. I have a 0.55% interest every year in my savings account. If I just let my money there, they are going to lose 2% on average value every year, which means I have to put my money in the mechanism of economy. But we are going to talk about this in another video. For now, I can say that this is all I had to say for inflation. If you enjoyed the video, please leave it a like and let me know in the comments down below what is the thing that you understand the less when it comes to economy. And I'll see you in the next video. Why does a certain thing cost $100 and another one costs $500? How are prices given? Who decides what price is the right price for that product? In this video we are going to understand how prices work in the simplest form.